But that's not why I own gold. That's why I own gold shares. I own gold because I believe that gold is a great form of liquidity. It's insurance against collective stupidity. And collective stupidity is in great abundance. Well, when is the gold price going to move? I say, people are looking for quantum increases in gold. The type of increases in gold that they got in the period 1970, 1980, or 2000 to 2011. I think we might see those too.
Why they do it this way, but they have the gold in their balance sheet on the asset side and the revaluation account, which mirrors it on the liability side.
That what you saw that Thursday, Friday, and the following Monday is a precursor of what's to come. It basically opened up the door to the system completely being margin called. And that's what we're going to face over the next few months, is a giant margin call that cannot be met.
In today's weekly recap, three financial experts, Bill Holter, Andy Schectman, and Rick Rule, talk about the recent price moves and macroeconomic news that have happened this week. We watched hours of footage to bring you the best clips so you don't have to. BRICS Master Plan, the upcoming banking collapse, and how rate cuts impact gold and silver prices are the main topics of this show. If you're a gold and silver stacker, this video is for you. Smash the subscribe button, hit the like button, and turn on notifications so you do not miss out our recaps. Enjoy the episode.
Why people even question how gold's strength it's been so resilient, and Bitcoin corrected and the market sold off, yet gold's been so resilient. And I guess my point, Dunnigan, would be, how many more times do you need to hear this before it sinks in? Again, another record being made. First 6 months of the year of 2024 represent the most gold central banks of the world have ever purchased, ever. And it only superseded last year's first 6 months. And you, at the top of the list, you have Turkey and India, of course, China, you have Poland. And it reminded me of something that, and I went and I dug this up because a couple years ago, Adam Glapinski, who still is the head of the Polish Central Bank, said something very interesting. In my mind, he tipped his hand, because in 2021, he said, and I'm going to read this to you, he says, he was trying to explain why they were expanding the country's gold reserves by 100 tons. And when he announced the plan to expand it, he said the following. He said, our gold reserves are a matter of financial security and stability. Gold will retain its value even when someone cuts off the power to the global financial system, destroying traditional assets based on electric accounting records. Of course, we do not assume that this will happen, but the saying goes, forewarned is always insured, and the central bank is required to be prepared for even the most unfavorable circumstances. That is why we see a special place for gold in our foreign exchange management process. And here again, they're buying truckloads. I don't know if any of you have seen that movie that the Obamas produced. I didn't know they produced it till after I watched it. It's quite frightening, actually. It's a movie where the whole grid goes down and the internet goes down and the ability to communicate goes down, and how fast things go pear-shaped. And you can only imagine, when you contrast something like what Glapinski is saying with the Microsoft outage recently, and then even more concerning to me, it's interesting. You see the insiders sell so much leading into the end of the second quarter, right? And then we see the biggest one-day drop on the Nikkei, a massive drop in South Korea and in other parts of the world, and the biggest number drop ever in the Dow. Of course, they're all out. But when that happens, all of those exchanges go dark. Robinhood whatever. What am I trying to say? Vanguard and TD Ameritrade, all of these, and Schwab, and yeah, they all go blank, right? At the same time, what are the odds? And when you hear him say something like this, it brings back to, I think it really underscores the whole point of counterpart liability, of what would happen if the grid went down. We keep hearing about that, little pieces, EMP and grid and electric and this movie, and how everything is it's it's all digits on a computer screen, including the banks. So I don't know. I thought that was kind of interesting that he said that. But here again, you got the central banks buying more gold than at any time ever. But this has been...
Now, in the continuation of the episode, Bill Holter discusses his silver prediction and shares with the stackers why he's stacking more silver than ever as something big is about to happen.
If the system down, what is it exactly that you're going to buy? I mean, are you going to go to your local grocery store or Walmart or the gas station? Or you think you're going to go out to a Friday night dinner? Good luck. Everything's going to be closed. There won't be anything. I mean, think about when a hurricane comes. Your grocery store is wiped out in 3 days because there's not little elves in the back room baking loaves of bread and canning baked beans for you. So they're going to be empty. The whole idea behind gold is it transfers your wealth from the current system into the next system. And because everything's going to be reset, you're going to end up having relatively more capital in purchasing power terms. I mean, you can go out and you can cut a deal with somebody. I'll give you 100 ounces of gold for your house. And I mean, it can be done. You can do that today, but you're doing it on a one-to-one basis. It's not like you're going to be able to walk into a grocery store, with junk silver and use it, but you sure as hell are going to be able to go to a farmer, assuming you live rural. If you live in a city, well, good luck to you. There is no hope. If you live in a city, you're going to perish when this goes down. But if you're living rural and you can find a farmer that's got eggs or pigs or cows or whatever, they will accept junk silver. I mean, I've gone to plenty of farmers markets, talked to farmers, and asked them, when things go bad, will you accept junk silver? And 9 out of 10 will say, I'd rather take junk silver right now. I would say buy gold maple leafs. And if you can find Canadian junk, which is very, very hard to find, you would want that. Your next best would be Canadian maple leafs. As an American, you want the coin of the realm. You want gold eagles or pre-1933 gold. And in silver, as it stands right now, for what possible reason would you buy any other form of silver right now? Because junk is basically the same price as bars or generic coin or whatever. A year ago, there was a $10 premium. So the premiums have evaporated. You're buying silver in basically its cheapest form. And by far and away, the form of junk is the absolute best form for an American to own. It's the smallest denomination. It can't be counterfeited. It's readily recognizable. And it's U.S. mint lineage. I mean, junk is the absolute best form for an American to own. And I don't know if I'm the largest broker in the country with junk silver on the books, but I'm definitely one of the 10 largest brokers in the country as far as getting junk silver in customers' hands. Because that's really all I've done since, I'm going to say 2017. And other than IRA accounts where you've got to do something that's 99.9, in which case I've done silver. Have I done a few bars or generics because, people are jumping up and down. No, I don't want junk. I want the crappy bars. I want the crappy generics. Those are not going to trade. You will not be able to barter with a generic coin or a bar when this thing goes down, because the other side of the transaction is going to look at it and say, how do I know this is real? Because they're easily counterfeitable. Junk, you cannot counterfeit. If you had a counterfeit dime or a quarter, brand new, they'd be shiny. And if somebody wants to give you a shiny 1937 dime, run away from it, because there's no way in hell that that's a real dime or quarter or whatever. It has to show where.
In today's news recap, analyst predicts silver prices could reach $200, driven by demand for new EV battery technology. A financial expert with over a decade of experience in commodities markets has predicted that silver could reach $200 per ounce in the next 10 to 15 years, riding the wave of increased demand for a new EV battery technology developed by Samsung. According to Bambro, the new batteries may require 1 kilo of silver per car, driving silver usage sky high. Bambro believes that the precious metal will be able to reach $200 per ounce prices, supported by the emergence of a revolutionary new electric vehicle battery technology that uses silver in its structure. The new solid-state batteries developed by Samsung feature a silver carbon composite layer for the anode, allowing them to have an increased life, dramatically reduced charging times, and larger operating longevity. According to his estimates, each battery cell might require up to 5 grams of silver, putting the whole requirement for an average car battery at 1 kilograms. Bambro assesses that if only 20% of the yearly global car market adopts this kind of battery, 16 million EVs, it would increase silver demand sky high. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hit the like button, and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
Traditionally, during periods of time when investors have come to be concerned about the maintenance of purchasing power in conventional assets, particularly bonds, but also equities, the primary beneficiary has been gold. Gold is under-owned. Less than 0.5% of the savings and investment assets in the United States are comprised of gold and gold-related securities. The 4-decade mean market share of precious metals is 2%. If interest in gold merely reverts to mean, demand for precious metals and precious metals-related assets grows fourfold. If you juxtapose my warning, which is that we're suffering a negative real yield, and that negative real yield increases as government obligations increase, where traditionally the biggest beneficiary of that disconnect is gold, and where gold is substantially under-owned, I think that there is a probability rather than a possibility of a return to mean. I have no idea what would happen to the gold price or the price of gold shares if you increase demand for them fourfold. But I have a feeling I might find out, and it will be at the very least interesting, and I suspect for me, pleasant. People from your show talk to me and they say, well, when is the gold price going to move? I say 2000. In the year 2000, it was $253 an ounce. Now it's $2,400 an ounce. It's increased at 8.4 or 8.5% compounded for 24 years. So when is gold going to move? 24 years ago. People are looking for quantum increases in gold. The type of increases in gold that they got in the period 1970, 1980, or 2000 to 2011. I think we might see those too. But that's not why I own gold. That's why I own gold shares. I own gold because I believe that gold is a great form of liquidity. It's insurance against collective stupidity. And collective stupidity is in great abundance. At the U.S. economy, they say, well, why should American debt to GDP at 120% be problematic? The Japanese ran for a long time, over 200. It went on until it didn't. The Japanese individuals had much higher per capita savings than the Americans do, and hence they could afford to be stupid for longer. I remember, and you'll understand where I'm going with this in a while, being not unsophisticated financially myself, driving 20 years ago, and seeing a big billboard on my right, on the right of the freeway, that said, borrow 125% of the value of your home. Bad credit, okay. And I remember as a lender thinking, I'm not sure this works out okay. But I didn't correlate that complacency with the crash of 2008, although they were directly correlated. It turns out that people don't pay too much attention to warning signs that are statistical until the trap has already been sprung. People should go out and look for catastrophe, and having found it, curl up in the corner in fetal position and do nothing. All I am suggesting is that people begin to construct their portfolio in a way that ensures them against contingency. That's all I'm suggesting. And I think that the events of last week likely make your audience a fertile resting place for that admonition.
What do you think of the weekly recap? Are the three experts spot on? Are they clueless? Post in the comments section down below your honest opinion and share with the stackers your gold and silver price prediction. Are you selling at any price? And if you like this video, watch this one right here because it's a perfect fit for you. I'll see you on the other side.